So based on the frameworks that you've described already, which assets that you've researched are currently in a bubble, if there are any that fit your frameworks?
So one might, so you're in Canada.
Yes.
So one
Okay.
might
I see where you're going with this.
what one might suspect that in Canada there's a property bubble, but people have been saying this for nigh on 2 decades with
Yeah.
respect to Canada. And
Yeah.
there's been real things happening in Canada in terms of, the growth of the economy, migration, et cetera, driving it. I was in Toronto 14 months ago, and I hadn't been in Toronto in 20 years, and I couldn't believe how Toronto had changed in those 20 years with all the
Mm-hmm.
high rises. And
Mm-hmm.
then talking to people about property prices, stuff super marketable. You start packaging, apartments, they come super easy to sell. Maybe there's a bit of overconfidence. And so potentially there we might see something.
Financial bubbles are always at the top of investors' minds. How do we identify bubbles? What are the metrics and indicators we can use to spot one when we're in them or when one is coming? Which assets are currently in a bubble per the strict definition? Well, let's find out with our next guest, John Turner, who is an expert on this subject. Professor Turner is a professor of finance and financial history at Queen's University of Belfast. He was formerly the Alfred D. Chandler Fellow at Harvard Business School, and he's written a book called Boom and Bust: A Global History of Financial Bubbles. We'll be examining some of the themes from this book and bringing it forward to our present time. But first, a word from our sponsor, iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. Also, it has unique tax benefits. So if you're over 18 and you like to open a new account with cash or roll over an existing IRA account, click on the link down below at itrust.capital/David to learn more and get started. Professor Turner, welcome to the show. Great to see you.
Thanks very much, Steve, for having me.
Your book, Boom and Bust: A Global History of Financial Bubbles, which you've co-authored with William Quinn, examines the history of bubbles going back 300 years. So let's start with the definition, the academic definition of what a financial bubble really is.
Okay, so this is quite a controversial area amongst academics, but let me go into the origins of the word bubble, the
Yeah.
etymology of it, because I think that's kind of interesting. It tells us a lot about what a bubble is. And so the first time the word bubble appears in the English language is actually in William Shakespeare in his play As You Like It, the famous "All the World's a Stage" speech that he gives there.
Right.
And there it means something which is fragile, empty, worthless, a bit like a soap bubble. Then throughout the 17th century, we see the word being used more frequently then. And it also has this other meaning now, and that's to deceive. Okay, so it becomes a verb across the 17th century. And then in 1719, 1720, two famous satirists, Daniel Defoe and Jonathan Swift of Gulliver's Travels fame,
Mm-hmm.
they were looking at the London stock market, and they were seeing all of these companies popping up. They thought they were worthless. They also thought many of them were deceptive. And so they called them bubble companies. And the name stuck, the metaphor then stuck. And over time, we keep using this word bubble to mean something that's fragile, empty, worthless. But it's maybe a bit less pejorative today than, say, Defoe and Swift were saying it in 1719. That's in terms of the origin of the word. But in terms of how financial academics think about the word, this is where the controversy comes in. So I know on your show you've had Eugene Fama, the Nobel Prize winner,
Yes.
in the past. And if you're to ask him, what is a bubble? Well, he would say there's no such thing as bubbles.
Right.
In fact, he's on record as saying the word drives him nuts because it's devoid of meaning. Others, so when Fama said that, he said that in 1990, but there's been a lot of bubbles since 1990. Others then have come along and try to say, well, okay, it's when the asset value disconnects from its fundamental value. That's when we have a bubble. Problems with that in the sense of, how do you determine the fundamental value? So I'm an historian. Even looking back at previous bubbles, it's really super difficult to determine what the fundamental value of an asset was, even with all the information we have. So our definition it follows, I suppose, the godfather of bubbles, and that's Charles Kindleberger.
Mhm.
And he defined a bubble as, an upward movement of price over an extended range followed by a collapse in price. So in the book, we simply parameterize that. So if something goes up by 100% over the space of 2 to 3 years and it collapses by 50% over the space of 2 years, then we think that's a bubble.
Mhm.
So that's our very basic definition of a bubble.
Okay, so it's interesting you brought up Professor Fama. So yes, I've had a chance to interview him. He actually, in a paper, he outlined that the word bubble is treacherous in his words, because there's very little evidence in his, according to him, there's very little evidence that a sharp increase in an asset's price will necessarily lead to a sharp deflation of said price or asset. How would you respond to that?
Oh, he's absolutely right on that. Just because something's going up in price doesn't automatically mean that it will fall in price. But nevertheless, we do see these periods where we see these increases in asset price followed by significant falls in asset price that cause all sorts of damage to the economy. So since he has said that, we have come through the dot-com, we have come through the housing bubble in the United States and Spain and Ireland and in the UK.
Mm.
China's had several, massive bubbles. We've seen cryptocurrency bubbles. So I think the experience of our eyes tells us there's something out there, and we need to understand that something.
So bring it to current events. Well, several notable investors in financial media have criticized the S&P 500, calling it a bubble today. So we have Jeremy Grantham, who claims that the stocks are currently in a what he calls a super bubble. Now, Michael Burry, as you know, also who has correctly predicted the subprime housing crisis, is famously he placed short bets in the S&P earlier last year. What would you say to those people who are claiming that the S&P 500 and perhaps even the Nasdaq are currently in big bubble territory simply because of how valuations have been stretched?
Yeah. So one of the things that we do in the book, and we're very humble because we're not very good at predicting bubbles. Even though we have spent, my co-author and I have spent years studying these historical bubbles, it's really difficult to predict them in real time. And so you're asking today, is S&P 500 in bubble territory? So what we do in the book is actually develop a framework to help investors think about whether or not there's a bubble. So the basic message of the book is this: we think bubble is the wrong metaphor. It really should have been fire. And so we developed what we call the bubble triangle, which is akin to the fire triangle in high school chemistry that you remember. So heat, oxygen, fuel. Those are the three necessary conditions. So bubbles are exactly the same. There's three sort of necessary conditions. First of all, the fuel is the money and credit. So super low interest rates, that encourages investors to reach for yield. Super low interest rates allied to low sort of credit, sort of banks expanding credit or lending. So that gives fuel to the fire. The oxygen is the marketability of the asset. And this is something that over the past 300 years has changed a lot in financial markets. Things have become way more marketable. So we can think here of technology driving it. We can think of regulation driving the marketability of assets. So assets today are super marketable, really easy to buy and sell stocks. And then the heat is the speculation. And this is where all these historical bubbles we observe in the book, we see hordes of amateur investors flooding into the market to buy shares, to buy houses, to become investors for the very first time. And also during these bubbles, it's really hard to short the bubble assets because there's constraints on arbitrage and it's pretty difficult through most of these historical bubbles to actually go short on what is the bubbly asset. So those three conditions, and so we say to investors, are those three conditions present? If they are, we're in bubble territory potentially. But then we also have to ask, well, what's sparking the bubble? What's the thing that really sparks off the fire? And in the book, looking at all these historical bubbles, there's two things. One is a radical new technology. So a new technology comes along, gets speculators really excited about it, and they start bidding up asset prices, and then the fire basically goes from there. Or the more common one is sort of politics the role of policy, the role of governments in actually engineering and creating these bubbles in the first place. So investors need to be on the lookout for, well, are governments trying to do something at the minute to the market? Is there a new technology on the market that could be potentially driving these valuations? And then those three sides of the bubble triangle. And if all of those are present, then we're in bubble territory.
Can an asset collapse without it being in a bubble first?
Oh, for sure. So a new company sets up and all of a sudden no one wants its product or its services anymore. The asset collapses. That happens throughout financial history. So companies set up.
It may have been fairly valued to begin with, but for unforeseen, unfortunate circumstances, that particular stock just
Yeah, yeah,
collapses. But it
yeah,
doesn't.
yeah.
It wasn't necessarily in a bubble. I want to talk about
Okay.
assets that don't generate a cash flow. So when we
Mm,
talk about a stock, we can value the stock based on its net present value of cash flows or other valuation metrics, and then that can give us a barometer of whether or not something is under or fairly valued or overvalued. But what about things like gold or Bitcoin, assets and commodities that don't generate any yield on its own? How do
mhm.
we value those things?
Okay, so even with stocks, on occasions it's difficult to value. I can remember living
Mhm.
through the dot-com crash and bubble, and how were people to value all these dot-com companies that
Mhm.
weren't producing any profits?
Yes.
Cash flow was really, really low. So people were using clicks and visits. This was the
Yes.
new way
Yeah.
of
Price
um,
per click, I remember, was
oh
one of
yeah,
the
yeah, yeah,
metrics.
yeah.
Yeah.
But then you come to something like gold
Mhm.
or cryptocurrencies, and really what's driving those asset prices is the demand and supply, and so investors go into those assets thinking, okay, I want to hedge some risk potentially, and they're trying to think, well, where's the gold price going to go, where's cryptocurrency prices going to go based on supply and demand. But as you say, it's really hard to value because there's no cash flows coming from it. We can't do that. So we're trying to figure out what's going to happen in the future.
Yeah.
Where's the demand supply for these things going?
Well, in that particular case, let's take Bitcoin, for example.
Hmm.
The other factors you mentioned, would they be a little more important, like the marketability aspect of a particular asset? As you know, there was a huge hype, there was huge hype around cryptocurrencies all throughout 2020 and 2021. Um, so so a lot has been emphasized on the marketability front. When you look at an asset like that, a new emerging technology that is really hyped up, really marketed in your words, is that the prelude usually to a bubble?
So it certainly helps. So if you think of what happened pretty much from the first lockdown during the pandemic through to the end of 2022, what happened? Cryptocurrency prices. So prices go up by 600, a broad-based index of cryptocurrencies. Prices go up by 650%.
Hmm.
uh, up until about, I think it was November 21. Then over the next year, they collapse by roughly 66 to 70%. Bitcoin itself, I think, fell by 75% across that
Yeah.
period. And you're absolutely right. It all comes down to the marketability of these things. So if you think of what was going on during the pandemic in the run up to it, you had Coinbase, you had FTX, you had Binance, you had Robinhood, you had all of these new apps that allowed a new generation of Gen Z investors coming into the market to easily buy and sell cryptocurrencies. My brother, who's not a finance person, was buying and selling cryptocurrency.
Yes.
My son, who was 14 at the time, was buying and selling
Mm.
cryptocurrency. This is what people were doing because we made it so marketable thanks to those apps.
Uh, okay. And what was the end result of this super marketability of a particular asset?
Yeah, so in the case of the cryptocurrencies, so you've got the super marketability. You've also got a lot of bored millennials during lockdown. Sports betting was off
Yeah.
you couldn't bet in baseball or soccer. So it's almost like becomes like a casino. It's all and the gamification of this as well. You have
Right.
super low interest rates, like during the pandemic, like interest rates and have been super low for a long time, and that then causes investors to reach for yield. You've also got
Okay.
margin trading, which is kind of super interesting as well for investors coming in. So this is like the fuel that's driving all of this,
Right.
and all of these combined together, perfect storm, and we get this bubble in cryptocurrencies.
So based on the frameworks that you've described already, which assets that you've researched are currently in a bubble, if there are any that fit your frameworks?
Yeah. So one might, so you're in Canada.
Yes.
So one
Okay.
might
I see where you're going with this.
what one might suspect that in Canada there's a property bubble, but people have been saying this for nigh on 2 decades with
Yeah.
respect to Canada. And
Yeah.
there's been real things happening in Canada in terms of, the growth of the economy, migration, et cetera, driving it. I was in Toronto 14 months ago, and I hadn't been to Toronto in 20 years, and I couldn't believe how Toronto had changed in those 20 years with all the
Hmm.
high rises, and
Hmm.
then talking to people about property prices.
Hmm.
And so all of a sudden you're beginning to think, should we be worried about property prices in Canada? Because again, we've lived through this long period now of very low interest rates up until recently, where interest rates were hiked because of inflation. Stuff's super marketable. You start packaging, apartments. They come super easy to sell, and maybe there's complacency has seeped into sort of the monetary authorities in Canada and the regulatory authorities, and we didn't have a financial crisis, they would say, in 2008. We survived that. So maybe there's a bit of overconfidence, and so potentially there we might see something. I think we've been living through something in China as well with its property market.
Yes.
So it's at the tail end of bubble territory. Um, I'm always worried about new technologies when they come out and when people start to hype them. So
Mhm.
AI being something that we might see a lot of investors hyping it, a lot of people hyping AI because they want to basically sell and get their product out there. But so that's something that we might be worried about. But I can't think of any other examples just off the top of my head of,
So
of assets that I'm worried about.
you don't think that the stock market indices in the US at least are currently in bubble territory?
I think it's so the thing with stock market in this, the broad stock market, it's really, really difficult for
Okay.
there to be bubbles there because of short selling. It's so because of the big companies, it's so
Hmm.
easy to short sell. So uh, I think no,
Okay.
listen, there could well be, but I don't. I think it's very hard for an overall market like that to be in bubble territory.
Well, you referenced the dot-com bubble. Do you see any
Mhm.
similarities today with the Nasdaq to 2000 or 1999 Nasdaq?
Yeah. So I think so. Having lived through and by the way, this is the thing that really got me interested in bubbles. So I was
Yeah.
a young finance professor teaching MBAs, and they're all buying .com stocks, and they're saying to me, "Why aren't you buying .com stocks?" And I'm saying, "Well, because I've seen bubbles happen in the past, and this looks like it smells like a bubble." Um, so thinking of some of the things that we might be worried about. And again, we saw this during the pandemic in terms of some of these asset classes. So, Tesla was a prime example. So its stock fell, I think, about 60-70% from its high during the pandemic. You've um, green technology stocks. Again, because there's a political sort of element to that. So there's a new technology element with green technology stocks, but there's also then a political push with regards to that. So those are things that I would be looking out for or wary of. I'm not saying they're in bubble territory, but those are things that I'm kind of new technology is always something that's prone uh, to being a bubble.
Okay. Can you evaluate this I guess, approach to valuations and thinking of bubbles. So one of the criticisms towards Bitcoin that I've heard from non-Bitcoiners or people who don't like Bitcoin is that the asset itself doesn't have any intrinsic value. And people define intrinsic value in different ways, but one of the ways you can define intrinsic value is that it's not being used for anything practical, is one of the arguments against Bitcoin. It doesn't generate a cash flow on its own. You can't use it in physical products. It doesn't have any applications unless you're talking about layer twos and smart contracts built on Bitcoin. And so it doesn't do anything. The only thing that drives up the price is other people bidding it up. That's kind of just a Ponzi scheme. So by definition, the asset is always going to be a bubble because the intrinsic value is zero. How would you evaluate that?
Yeah. So yeah, I've heard people obviously describe Bitcoin as a sort of Ponzi-like scheme. I don't think that quite is accurate,
Okay.
because Bitcoin does have a use. And this is where we look at the origins of Bitcoin. Bitcoin
Okay.
was, part of the dark web. This is how, people engaged in nefarious activities. They used Bitcoin, and Bitcoin is still useful for people involved in nefarious activities and for people wanting to move money out of regimes which, where there's capital controls, or regimes where there's authoritarian governments trying to, seize people's assets and do things. Bitcoin's super useful for doing that. So it has a use, and I think a lot of its value then. So a lot of speculators who buy and sell Bitcoin, it does have an intrinsic value. It's a vehicle for helping people move money undetected from the government.
Right. When we think about things that don't have much of a use case, being in a bubble, I think naturally investors are a little bit skeptical or worried about touching assets that don't have much use case. I think a famous example that historians study is the Dutch tulip bubble of the 17th century. Can you maybe walk us through exactly what happened? Just summarize it in two minutes or less. What the deal is with that? Why is it that tulips all of a sudden became the biggest bubble at the time and then deflated, obviously collapsed, as we know? Uh, Certainly, I don't believe tulips were used for a lot of practical purposes. I think they were more of a collectible. So I think it's a good case study.
Yeah, so this is something we don't actually have a chapter on the book on tulips, because we
Yeah.
dismiss the tulip. So the tulip mania, as it was called, happened in the 1530s, and when journalists today write about bubbles, they usually cite the tulip mania as like the first major bubble, but that's not quite accurate. So we know about the tulip mania in the English language thanks to a journalist from the 1840s called Charles Mackay. He wrote this wonderful book called The Extraordinary Popular Delusions and the Madness of Crowds. And he talked about all these manias that affect people, the witch craze, and various others. And he talked about the tulip mania. And then it passes into everyday, talk. We all talk about the tulip mania thanks to Charles Mackay writing in the 1840s. But Charles Mackay actually, so this is where the historian in me comes in. Charles Mackay used the wrong sources, and he misinterpreted the sources. The actual tulip mania wasn't really a mania. It was a satire. So all of a sudden, people in Amsterdam are becoming wealthy. They're spending money on porcelain and all these things, on flowers and various other things. And so then these satirists create this idea of the tulip mania, really to poke fun at the new rich that are emerging in Amsterdam. And so it's just a pure piece of satire. And then it passes into folklore, and we all think, hey, there was a bubble in tulips, but there wasn't a bubble. And we actually observe this with every single bubble there is. You see these pieces of folklore that actually aren't true. A famous case, there's a bubble happened in the English stock market in the 1825. And there was a couple of wags wrote into the newspapers about this new company they were forming. And one of the companies was retrieving the cannonballs from the Napoleonic Wars from the English Channel, and they were going to recycle the cannonballs from that. A complete fabrication. But people started to believe it, and then it is passed into folklore
Uh-huh.
as, oh, this is how crazy people actually were. They were doing that type of thing. So the tulip mania is a myth, unfortunately.
Okay. Okay. So that I think that's news to a lot of people who
Yeah, yeah.
who who constantly cite this tulip mania as an example of a. So what really happened? Nothing really happened.
Stuff was happening in the sense of people Amsterdam, in the Netherlands, people were getting very wealthy, and they were spending money ostentatiously. And so the satires were basically poking fun at people spending a lot of money on flowers and bulbs and various variety of bulbs. And
Okay.
disease was introduced into bulbs to make really nice tulips and that type of thing. And so really it was all propaganda, and it's passed down then as well. Actually, there was a mania.
So in your book, you've outlined how it's difficult to predict bubbles. Just
Mhm.
from a chapter here, the chief lesson for investors from our book is that they need to act like fire safety inspectors, examining each situation to see if the elements of the bubble triangle are present and looking out for political or technological sparks. In other
Mhm.
words, treat this as sort of a risk assessment exercise.
Mhm.
Is it even worth inspecting for bubbles that if it's difficult to predict and nearly impossible to time?
Yeah. So I suppose when we wrote those words, we were kind of writing for the amateur investors that we were thinking of that are really
Okay.
help drive these things. And so our warning to amateur investors is you pretty much want to stay out of these things rather than get involved. But for professionals, then I think we provide a lens here to think about, how you go about detecting bubbles. And it means you have to know finance, economics, and we say there in the rest of that quote, you need to understand investor psychology, you need to understand politics and geopolitics, and you've got all of these mental models as an investor that you're using, and the best investors have all of these mental models as they look at the world they're thinking of investing in.
Can you provide a few examples of how a professional investor may approach um, identifying a bubble? You've outlined other factors that they have to consider, like geopolitics and macroeconomic forces. But concretely, what are some
Yeah,
of the
yeah,
things you
okay.
can use?
So,
Yeah,
if we take, for example, the housing bubble
sure,
that happened in
sure.
the US, also happened in parts of Europe, and here in Ireland, where I'm based. Um, uh, and if someone's sitting looking at that situation, they're sitting going, okay, um, what's the again, you're going to a fundamental, what's the sort of the rental yield on these properties, what's the ratio of income to the house purchase price, uh, how generous are the banks in lending,
Hmm.
how many bank loans are going to buy to let property investors, how many bank loans are going to people who are have 100% mortgages, or here in the UK and Ireland we had 125% mortgages.
Yes.
So you're looking at all of those factors. You're looking at why is the government really wanting to push the housing market, and governments are so wrapped up in housing markets.
Hmm.
Uh, they don't want house prices to fall coming up to a general election. Um, house prices, people who vote typically are house owners. And so governments have a role. And in the 2000s housing bubble, one of the roles of government was they wanted people from lower income groups to own houses. That's so the United States, Spain, Ireland, UK, we have very poor social housing provision. And so these four countries all tried to provide houses for low income families using the banking system, encouraging people to buy houses. So if you actually look at the bubble in property prices, it's at the lower tier of houses where the bubble was most acute. So you go around all the big US cities, and
Sure.
it's at that bottom tertile of houses. Same was true in Ireland, UK, and Spain as well at the same time. So
So,
you're
so
looking at all of those things, and as an investor, you're trying to say, all right, there's something wrong here. This
it,
doesn't look right.
is there a threshold that you would assign such that after this threshold it becomes a bubble? So let's take the property market, for example, that you mentioned. So price to rent is one particular ratio. Do you think to yourself, okay, well, it's gone up maybe from 15 to 20. Well, it's not yet in bubble territory, but it's now two standard deviations above the mean.
Mm-hmm.
Now it is.
Mm-hmm.
So is there some sort of level that you look for before you
So so
say
so
that is,
so
yeah,
yeah. Again, investors really want a metric, a really nice metric.
Right.
But
Yeah.
our point is that there's no one metric that you can look at. So those things are important. Those
Yeah.
metrics are important, but you need to think about all of these other things. How I knew that there was a housing bubble here in Ireland. So
Hmm.
house prices trebled in the space of about 7, 8 years and then collapsed by 50, 60, 70% in some cases. How I knew there was a bubble was I was selling my first house, which was like an entry level home,
Hmm.
and people are coming around to view it, and you're always trying to figure out, well, are they going to deliver it and follow through when they make a bid? And all of these people were coming through who were unemployed,
Hmm.
who had no income. And I asked them, how are you going to afford it? And they said, well, the banks are giving us 105% mortgages. I'm going, they're giving you 105%
Wait,
mortgages?
so what is 105%? What does that even mean?
So they give you the value of the house, and then they give you an extra bit of cash to help
Why?
furnish it and pay the lawyer's
Why are they
fees.
doing this?
Well, so good question. Because they've been so heavily deregulated and allowed to get off with it. We actually had 125% mortgages in the UK.
You're kidding me.
And these banks all end up
Yeah.
crashing, of
Wow.
course.
Wow.
So that's how I knew there was a property bubble.
That's remarkable. Okay. Um, Fair enough. So I think you're speaking from somebody with a lot of experience, and you're seeing this is not normal, obviously, and
Yeah.
you're using a lot of qualitative metrics to assess bubbles. Okay. Well, what effects do bubbles have on financial markets? Again, this is a very general question, but what
Mm,
effects do bubbles have once they are popped, once we feel the full effects of a deflation of an
mhm.
asset?
So we spent a lot of time in the book actually thinking about this question.
Hmm.
And bubbles popping actually, or bubbles sometimes can be quite useful, because they help fund and provide a new technology. So if you think of the .com, there wasn't much of an economic sort of fallout from it. But hey, we had this amazing new technology that really has transformed the world since the year 2000. The same was true with some of the other technology bubbles that we talk about in the book. The new technology, helps drive the economy forward. Where bubbles become problematic is where they're driven or engineered by governments and where banks fund the purchase of the bubble asset. And so in those cases, we could be talking about, uh, you know, recessions, depressions,
Hmm.
and low economic growth for decades. So I remember as a student in the early 1990s, everyone was talking about Japan. That's the next economic model. And then, of course, Japan's economy collapses in the mid 1990s after a huge property and stock market bubble. And they still haven't got back to where they were, 30 years ago. And then people start talking about Japan's lost decade
Yeah.
and then Japan's two lost decades. We think of the housing bubble in the United States, Ireland, UK. We're still recovering from that in terms of the economy and the distortions that introduced into the economy.
Right.
So the combination of banks lending to drive bubble assets and governments being involved, that's really deadly, and the long run consequences are quite severe.
Okay. I'd like to just go back to the property market one more time as an
Mm,
example. So my question is, what are the implications of a bubble? So in other words, what do I do with this information? So I'm looking at a ranking by UBS, in which they've ranked the top 10 cities in the world that are the most overvalued by their definition. I'm shocked Vancouver is not on this list, but whatever. It's UBS's list, not mine. Number one, Zurich, Tokyo, Miami, all bubble risk or overvalued territory, and then London number 10. You know, your usual suspects on this
yeah,
list. And
yeah.
they've used a number of metrics. My question is, what do I do with this information? Do I short those particular housing markets? Do I not buy there? I mean, people where I live in Vancouver, like you said in the beginning of the interview, people have been calling this market a bubble for 15 years and prices continued to go up. So I would have missed out if I didn't buy a home in the last 10 years.
Yeah, so this is where it becomes super difficult to identify bubbles because there are real things driving economies and driving property prices. So you've with the emergence of these sort of um, mega cities that attract all these young professionals,
Yeah.
and it drives property prices. But and also over the past 20 years, there's been a lot of foreign money move into property markets in these big mega cities, and so money moves out of China, out of Russia into all of these major cities, and so
Mhm.
that's going on. So what do you do in those? Well, you sit it out. You look at the rental market. You say, well, I'll rent, and you
Okay.
invest your money in the stock market or somewhere else,
Right.
rather than pay the crazy money that you need to pay to buy a property in those countries.
Okay. Last segment of the interview, I'd like to talk about how bubbles are created or
Mm-hmm.
made. We've talked about marketability, hype, and so on and so forth. Do you think central banks and governments have played a role in generating asset price bubbles?
Yeah. So for sure, central banks play this role. So fuel is one of the most important parts of a bubble, and the central bank controls the policy rate, and controls the amount of money in the economy. And one of the downsides of the financial crisis was we started using quantitative easing, and we
Hmm.
were hit the zero lower bound. That's just pure bubble territory, because all of a sudden people are going to be borrowing at those really low interest rates. People are going to be reaching for yield because of those very low interest rates. So central banks have a super important role to play in making sure they're not generating bubbles. But ultimately, governments are the major movers when it comes to bubbles. So the very first bubble that we have in financial history is what was called the South Sea bubble and the Mississippi bubble. So these happened in 1720. What these simply are is the French government and the British government were over indebted. They wanted
Hmm.
to reduce their debt levels. And so they created these companies that were going to buy up their debt.
Hmm.
And they simply engineered the bubble to refinance their debt. The British did it really well. The French made a mess of it. And it took the French economy nearly 100 years to recover from it. But that's an example of governments engineering bubbles. We've seen it in China recently. 2015, 2007, 2008, the Chinese government deliberately moving the markets, engineering bubbles. So governments play a super important role when it comes to bubbles.
Is it because of the money supply increase? Uh,
It's yeah, the money supply increase, but also they set the rules of the game. So if you think of property markets, for example, they set the rules of the game when it comes to banks
okay.
lending to property markets. They set the rules of the game in terms of uh, who can buy and sell shares and various things. They can manipulate their population. Uh, you know, use the press. So in the cases where the state controls the press, you can really engineer bubbles. So you see that in the Mississippi bubble, 1720. You see that in China
Mm.
with the state controlled press, but also the state control of social media that allows them then to influence investors.
Do low interest rates usually portend bubbles? Is there a relationship at all?
Yeah, yeah. So low interest rates. So there's a famous guy called Walter Bagehot, who is a former editor of The Economist in the 19th century. He's one of the first editors of The Economist magazine. And he has a saying, John Bull can withstand many things, but he can't stand 2%. And by John Bull, he meant the stereotypical English investor.
Okay.
And as soon as interest rates hit 2%, which in the 19th century was a super, super low interest rate,
Hmm.
all of a sudden John Bull starts reaching into all of these riskier assets
Mm.
and driving up the prices of these riskier assets. So low interest rates are always problematic.
Does the reverse make sense? Meaning higher interest rates pop bubbles?
Yeah. So again, some central banks have done this. They think there's a bubble, or they perceive there's a bubble, and so they put up the policy rate. And
Yeah.
putting up the policy rate is usually one of the things then that pops the bubble. A really good example of this actually is in Germany in 1927. The central bank thought there was a bubble in the stock market. There probably wasn't, and they put up interest rates, and that took the German economy into a deep recession and unemployment, and then hot in the tails of that, of course, the rise of National Socialism. So there's the popping of a bubble that kind of didn't go so well. So central banks have to be super careful when it comes to trying to pop what they might think is a bubble.
Okay. Now, final question for you, Professor. Uh, Next year in 2024, people are widely speculating or expecting interest rates to fall in the US and in Canada. Now, the Federal Reserve has signaled the end of rate hikes. What does this imply for financial markets? What do you think lower interest rates next year, whether it be a few cuts or a couple hundred basis points cuts, would mean for asset prices?
Yeah. This is a difficult question because we're not 100% sure if we've actually squeezed inflation out of the system yet.
Mm-hmm.
And so I think there's uncertainty about the direction. I know that this side of the Atlantic, there's pressure on governments to pressure from governments on central banks to basically begin lowering their policy rate, and of course then that's going to have consequences for stocks and for bonds. It's going to have consequences for property market. So the property market was beginning to feel it in parts of the world because of increased interest rates and borrowers then having to pay more to buy houses. So, it may have a good impact on people who've borrowed to buy their homes. But there's so many things could happen between now and this time next year that, all it takes is major geopolitical events to send oil prices going in the wrong direction, to affect supply chains again. We still haven't, people have lived through high bouts of inflation and their wages are catching up, or they're trying to get their wages to catch up. That then could feed into future inflation. So I still don't think we've turned the corner on inflation. And I would be urging, if I was talking to central bank, I would be urging caution.
Mm-hmm. Okay.
Particularly when you
Well,
look at the levels of government debt.
yeah. That was another point I had is the rising levels of debt. Actually, let's touch on this real briefly before we end. U.S. debt to GDP above 130%, I believe. Total debt to GDP. U.S. currently accounts for 30%, more than 30% of all global debt. Now, these numbers I find staggering.
Mm-hmm.
Can you assign the word bubble to a nation's debt level? Does that make sense in this particular context?
No, I don't think I wouldn't assign the term bubble. It's okay. So you can think of central banks overissuing money. You can think of governments overissuing debt. But yeah, historically, this is a high. We've all got these high debt levels, and indeed, when the pandemic started and government started pumping money into the economy, along with central banks, instantly I was thinking, well, this is going to lead to inflation because how do you
Yeah.
reduce the debt burden? Well, of course, inflation is like a really simple way of doing this. And when you can't outgrow the debt burden, uh, inflation's, a little bit of inflation sort of helps governments get down their debt burden.
Well, certainly when we think about a debt bubble, quote unquote, I
Mhm.
know maybe that's maybe a misnomer by academic
Mhm.
definitions, but people use that term
Yeah, yeah,
sparingly. So
yeah.
a debt bubble, I think it implies we don't obviously we don't think the debt is going to deflate or go away or collapse or whatever, but we
Hmm.
do think that other financial assets will suffer and collapse as a result of this
Hmm.
debt bubble. Do you
Hmm.
agree?
Oh, there's a couple of things that particularly with US debt, and so I think it really depends on who's holding it.
Okay.
And the flows of money. So again, a lot of money coming from China, from petro states into US debt, but that's been dialed back. And so then who's going to buy US debt? That's the problem. And of course, then there are other issues in terms of the presidential election. And if President Trump comes back into office,
Mm-hmm.
the problems that might create for um, the US economy and its debt holders.
Okay, excellent. Professor Turner, thank you very much for your time. Where can we learn more about your work? I mentioned you have, well, we've been talking about your book throughout the interview. I'll put a link to the book down below, but where else can we learn from you, Professor?
So I'm on X, formerly known as Twitter. So at Prof. John Turner is where people can learn more about my work.
Okay, excellent. Thank you very much. Well, speak again soon. Merry
Thank you very
Christmas and
much,
Happy
David.
New Year. Yes.
Merry Christmas, Happy New Year.
All right. Thank you very much, and thank you for watching. Don't forget to subscribe and like this video and follow Professor Turner in the links down below.